Good morning, everyone. Welcome to this update for global stocks and commodities for the 16th of February. And markets just keep rolling on. We had a terrific week the week before last. US market was up over 3% and put on another 1.5% in the week just gone. And it's the same story pretty much all around the world. So much for the havoc that the coronavirus was going to reap on world markets. Just hasn't happened. All right, in this update, I want to touch on, I guess this is something that I talk about pretty much every week, but what are the key elements that we need to have a great year in 2020? There's two things. First of all, you need the stock markets to be stable and sentiment to be stable. They don't need to go up. They just need to not go down in a sudden and protracted fashion, such as what we saw in the end of 2018, in the last quarter of 2018, when it looked like central banks were starting to go into an interest rate rising cycle. So we just need a continuation of what we saw in 2019. But then that's not enough, because there's a lot of low growth stocks, poor quality businesses that are fully priced or way overpriced, and it's hard to see them going anywhere. So the second thing that you need is an excellent stable of growth stocks that are bought well. So they're the two elements, and I'll be talking more about that as I go through. There'll be the normal stock and commodity trend update, and portfolio analyst last week. I looked at, apart from the fact that there were numerous really good member questions, I've got a lot of questions last week, but I looked at why markets rebounded so strongly, and we'll be talking about that as I go through this video. Now, also last week I mentioned the portfolio manager service that was more broadly launched last week. And members and subscribers were introduced to this funds management service that I've been running since January of 2019. Now, the results have been very pleasing to members and very pleasing to me, and we're up over 30% since inception. Now, how that return has been achieved is pretty much what I talk about basically every week. The elements are there every week. There's no magic to success in the stock market. It's just hard slog research. It's disciplined perspective on the markets. It's all those sorts of things that really produce those sort of results. And I'll touch more on that as I work through this video. But suffice to say, I'm really bullish and I'm really confident that the process that I'm using is a repeatable process on an ongoing basis. So more about that as we go through. Now, American stocks, the S&P was up 1.6% for the week, which was still a very, very positive week. So that makes nearly 5% in 2 weeks since, and whilst during that time, the coronavirus has, of course, been accelerating in the number of stats of people that are contracting it and dying from it. So the fear backdrop really couldn't be more pronounced, but the market doesn't seem to care one little bit. And why is that? Well, look, it's all the things that are important to the stock market, and the stock markets would see that the coronavirus, eventually authorities will get on top of it, either in the very short term or perhaps in the medium term, but they will get on top of it, and therefore it will disappear as an influence on economies and stock markets. What's important to the stock market are things like the US economic data, which is good enough, earnings, which are good enough to support valuations. We've seen the most strength and the most number of earnings beats in technology, healthcare, consumer services, consumer discretionary, those sorts of areas. So they're all good enough in the States. Plus, we've got global growth that's turning the corner, as I talked about last week. We've got low rates, and they look set to continue for a long period of time unless inflation kicks up and central banks are forced to act, and then things get ugly. But I talked about that last week, and that's the only two real fears I have for the market. One is inflation breaking out, but it's hard to see that happening because people have been expecting it now for 7 years, and it hasn't happened. And secondly, if a left-wing candidate and the Democrats won the US election, then that would be extraordinarily bad for the stock market, be extraordinarily bad for American economy as well. And then finally, we've got this massive central bank liquidity that also isn't going to go away anytime soon. So, that's what the market is focused on, and that's why the S&P couldn't even get enough downside pressure to break the 50-day moving average, as we talked about a couple of weeks ago. Now, in addition, US small business outlook is really positive. The deregulation in the environment, the removal of red tape, which we just so desperately need it in Australia. But the deregulation in America has helped small business enormously. The tax cuts have obviously helped small business enormously. We've got businesses now forecasting good increases in sales and profit. They're putting on more staff. Wages are rising. Whether you like Trump or hate Trump, there's not too many people that like him, but a lot of people hate him with a passion. But if you look at the facts and put emotions aside, he's done really good things for the American economy that just a whole succession of presidents before him failed to do. And the other thing that he's done is that he's actually delivered what he said, and that makes him a pretty rare politician on any scale. So the outlook for American small business is pretty positive. Now, there's been two big breakouts, one in 2013 and one in October 2019, that were highly significant and that really underscore the importance of using technical analysis and not dismissing it as some witchcraft voodoo, because it really does have an impact on the psychology of the market, and it does give signals that are highly revealing about what's coming next. So I'll look at both of those when we go to the chart. The US dollar extended recent gains, so I was dead wrong about the US dollar. I thought it would head down. It's back up now, pushing towards 100, and the 10-year yield was pretty much unchanged at 1.6. So let's jump in and take a look at the S&P, and we'll look at the monthly chart first of all. So here's the peak in 2000. Here's the peak in 2007. So we put a line of resistance through there. We had a big range that lasted for 13 years, from 2000 through to 2013. And then the S&P fluctuated between roughly 800 and roughly 1550. So a huge 13-year range. And when we broke out, I remember running a video at the time, and I put a chart there that showed the breakout, and the hypothesis was that if you looked at this purely from a technical point of view, and no one was prepared to acknowledge in 2013 that we were about to embark on what we've now seen, and the S&P has gone from 15, we'll call it 1600, and we're now at nearly 3400. So we've more than doubled. There wouldn't have been a person on the planet that would have said, hey, by 2020, the S&P is going to be double its current level. But that's exactly what the chart was intimating back in 2013. When you get a huge consolidation over a very long period of time, prices tend to run far further and for far longer than anyone could envisage. It happens at the index level. It happens at the individual stock level. It's just the way that markets work. And so that breakout in 2013 was highly predictive, as it turns out. And we've had a massive run where the US market has more than doubled. Let's zero in a little bit and look at the breakout that we got in October 2019. So we had a consolidation here between July and October, and the S&P fluctuated between around 2,800 and just over 3,000. So that breakout in October of 2019 was also highly significant because we've now moved from 3,000 points to nearly 3,400 points. So that's been pretty meaningful as well. Now, here's the pullback that we got from the fear about the coronavirus. And at the time, there was a a huge number of predictions saying that the market would, would come back to 3,000, come back to 2,500 points. All the bears were lining up to tell you how far the market was going to fall. And I said at the time, look, I don't know how far it's going to go down, but all I know is that I trade what I see. And what I see is that the US index has not yet breached the 50-day moving average. So until it does, let's continue on as though it hasn't. And that has proven to be the most profitable scenario. Now, at the time, I did put this little box in here. I've left it where it is as a talking point because I said if the 50-day moving average breaks, I wasn't predicting that it would, but I said if it breaks, then this is likely to be the sort of area that it would come down into, just as a probability target. But in the end, the 50 held. The market has gone straight back up again with lots of gaps indicating solid buying. So if we look at the last week, so here was the market, this red candle here last Friday. So we had a little bit of a sell-off on Friday on some negative news. But then look what happened. The market started the week with seemingly the virus being not a big issue because we had this really big rise on Monday. So stocks went up Monday, Tuesday, Wednesday. Then there was a bit of a dip on the open on Thursday, and that was because there was a big spike in the number of cases of the virus in China. And that was a lot about new reporting guidelines that had been started in China. So that meant that more cases were being reported. But also there was some pretty significant leadership changes. A couple of the key individuals in Hubei province got the bullet from Beijing, and new people were put in. And just as with any company, when a CEO gets fired for bad results and a new CEO gets put in, what's the first thing the new CEO does? He gets all the bad results out, gets everything out in the marketplace so that he's not blamed for it 12 months down the track. So I think it's a bit of both. And markets saw through that. And so there was an initial reaction here on Thursday. The market dipped for a couple of hours, but ended up only down a little bit. And then, of course, we closed higher on Friday and almost on the highs. So the downside just can't get any traction at all. I mean, that's the bottom line. So therefore, what I said a couple of weeks ago is until we see the market really rolling over sharply, then just don't worry about it. Now, with China in semi-lockdown, which they still are to a degree, that's definitely a problem for their GDP. Their GDP is going to take a hit. There's no question about that. And therefore, that's going to be a situation for the rest of the world. But markets are looking beyond that. They're looking at the China stimulus. They're expecting the virus to get contained. And they're looking at the things that are more important. And so that's why they've just gone straight back up again. So, just a reminder, you need to apply a very large filter to the media reporting that's out there about this virus. If you just accept what's coming through on a daily basis, you're being misled. You really are. So, just don't overreact to the media stuff on this virus. All right, so that's the S&P. We're overextended in the short term. We're pretty much in the position that we were back at in the third week of January. So I wouldn't be surprised to see a bit of a pullback to the 50. But at the moment, all we can say is the direction is up. All the moving averages are heading up strongly, and that's really all that we need to know at this point in time. All right, this is the US dollar. So we dropped out of the trading range, and then very quickly it turned out to be a false breakdown. And despite the way that the futures markets were positioned, and despite what Donald Trump wants, the US dollar has popped back into the range again and is still heading up towards 100. The Australian dollar remains under pressure. We had a little false breakout to the upside, got above 70 back at the end of December. But this year it's been down all the way, and now we're back down close to 67 again. So the Aussie stocks, 67.15 is where we finished. Our index up 108 points, 1.5% for the week, which pretty much mirrored what the US did. And the same story continues in our market. The technical disruptors are where the big gains are. These are the stocks that have propelled those results in Portfolio Manager. They've propelled the terrific results we've got through all of my services. It's just, that's the environment that we're in these days. So by tech disruptors, I'm not just talking about technology stocks, but it goes across a whole raft of the economy. It's financial tech stocks, it's biotech, it's defence, it's industrial applications in all sorts of varying forms. It's water treatment, environmental. It really covers a very, very large part of the Australian economy. But the element that is common to all these stocks that are doing so well is that they've got some sort of technology-driven product or technology-driven service. They've got capital light, highly scalable businesses that are addressing a global market. The elements are similar. And that's where the real progress is. High growth stocks, they're high probability of achieving that growth, and they're highly scalable businesses. So, that's the formula that's working. That's the formula that I'm going to be sticking to throughout 2020. Precious metals, gold rose by $14 across the week, so we're up to $15.84. So despite the fact that stocks are going up, gold also went up, and the US dollar went up. So it's a very, very strange mix at the moment. There's an even balancing in the gold market between positive and negative drivers. It's really, really hard to pick where gold or gold stocks might go in the short term. There's just enough fear out there, whether it's the Middle East, whether it's the coronavirus, whether it's growth, whether it's valuations, whether it's massive debt, whatever it is, there's just enough fear out there to keep the interest alive in gold, but not enough to cause it to break out. And then, of course, we've got the situation where the futures market is still very much too much on the positive side, meaning that there's very little incremental buyers to come in, and therefore it's a bit precarious. Precious metal stocks, GDX, again, it's done nothing. It's just compressing into a tighter and tighter triangle. So something's got to give fairly soon. That's GDX. That's the big global stocks. But if we look at the Australian stocks, we've had some tremendous results in the Australian market, and so let's just look first of all at GDX. So you can see this is a weekly chart as well. So we've been in consolidation now since August of last year, and we're just getting this compressed triangle building up, and I can tell you, we will get resolution at some point, and that point is probably not going to be too far away. Needs to happen fairly soon, because if you do tend to get all the way into the very, very tight apex, then it tends to then be a failure in terms of a strong breakout or breakdown. It then just seems to go into some sort of very, very difficult to discern sideways movement. So if we are going to get a breakout, it needs to happen in the next couple of weeks. Now, there's been some great results in the Australian market. The stock that I've talked about for years and years and years is Northern Star. I still don't see a better gold stock on the planet. And despite raising capital to buy half the super pit at $9, and the capital raising has only just been completed, look where we are. We're almost at $14. So just an amazing story, and amazing the way the Australian investing market has embraced Northern Star. Other commodities, copper up just a couple of cents, and very much dependent on China switching back on. Crude oil was up despite the fact that inventories went up, which would be a negative, despite the fact that the US dollar went up, which would be a negative, but it's really just rebounding from being oversold. There's the spot copper chart, not a lot of change, and no change in the spot nickel chart either. So just some final thoughts. The stock market is a lot about mindset. So many hedge funds are losing money betting on their logic. Their logic is that this can't continue, that the valuations are just ridiculous. There's all these reasons why the stock market has gone down. And look, honestly, their arguments can be very compelling. But the thing about most of these hedge funds is that they're consistently wrong, and they've either underperformed the market to an extraordinary degree, or they've just plain straight out lost money during that period. So, you've just got to go with what is in the stock market. Now, what favours the portfolio manager results continuing in 2020? Well, look, it's all the things that I've talked about throughout this video and throughout every week. It's the environment. The backdrop to markets for 2020 is sufficiently positive that sentiment is not going to suddenly turn terribly negative. The second thing is a large stable of excellent technical disrupting companies. And thirdly is just the buying discipline and the trade management discipline that goes with that. It's a process. It's not, it's not a game of luck. It's not a game of, hit and miss and hope you hit a few targets. It's a very repeatable process. So that's why I'm so bullish and enthusiastic about the results. Portfolio analyst upcoming this week. The results there are or the schedule, I still haven't determined what I might do myself, but getting so many great questions from members that, we end up with a pretty good edition anyway. Now, just let me just cover off on this chart, which I didn't want to be hidden. So I'll just put this chart up. So these are the actual results that we got in Portfolio Manager on a month-by-month basis. Now, January 2019 was a standing start, and so understandably, the results in the first few months were pretty modest. So these are percent gains or losses for the month. So you can see we had a very, very slight miss in March, and we had a bigger miss in December, but then we rebounded in January 2020 with a 10.5% gain. We had a great month in June, a solid month in July, really strong September, and a pretty good November as well. So 18.38% for the calendar year. We had 10.5% for January, and the results to date in February have taken that total up since inception now above 30%. So very, very pleasing results. So just to wrap it up, there's my contact details for anyone that's not a member of any of the services, that haven't tried the portfolio analyst trial. And then, of course, there's also a fact sheet available on Portfolio Manager. That's it for this week. At the moment, there's no reason to suspect that next week, this week coming, won't be another positive one in the market. And I'll be back with you next weekend. Cheers.